Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different ratios. And what ratios are, it's an asset priced against an asset. And we just look to see what is cheap in relationship to other assets. So if the ratio is low, the numerator is cheap. If the ratio is high, the denominator is cheap. So what we do is we look at these two different assets, we compare them to history. We look at them and we run through a bunch of different assets and we look to see what is cheap and what is improving. So we want a cheap asset that is improving against other assets. The ideal buy point, so to speak, is when you've got the large big picture view, kind of, let's say, the commodity to stock ratio in favor for commodities. Then you find a very cheap asset that is in the commodity sector, and that commodity sector can outperform all of the other sectors. It means it's the cheapest asset of the group. So that is the ideal, is when you've got, and you could have you could have a couple different assets be very cheap against everything else. And right when they're breaking out of patterns and starting to get better, that is the ideal buy point of like all time. And if you can get an alignment where you've got commodities cheap to stocks, and then you go through the sectors and you've got cheap sectors in relationship to the other sectors, those are the ones we want to hit. That's where you can get the 10, 20, 30. You can get multi-hundred baggers in relationship of an asset versus an asset, because some assets can go down while other assets go up. And that's where you can get these gigantic swings in relative performance. So, I mean, just to kind of really make this easy, let's just take platinum to gold, all right? And let's just do a 1-to-2 ratio. So right now, platinum's very cheap, let's say, and let's just say it's cheaper than this, but let's just say 1 ounce of gold can buy 2 ounces of platinum. So you take your 1 ounce, you buy 2 ounces of platinum. Over time, platinum outperforms gold, and eventually, 1 ounce of platinum can buy 2 ounces of gold. So you take 1 ounce of gold, bought 2 ounces of platinum, then that ratio comes back up, and then you have 2 ounces of platinum buying 4 ounces of gold. And that's how you are increasing your wealth. That is the entire point of investing, is to buy more of other assets. So when we look at this, you went from 1 ounce of gold to 4 ounces of gold in one round trip in that example. You've increased your real wealth by 3 ounces of gold. And that's irrespective of inflation, deflation, or the dollar price of that asset. Generally speaking, the dollar price of assets continually go higher over time. So when you traded, or when you purchased the 1 ounce and swapped it to platinum, generally speaking, the dollar value of all these assets are continuing to go up because it's an inflationary environment over long periods of time. So let's dive in here. Let's see what we got, and I'll give you my financial opinions around it. And I deploy all of what I'm talking about to the website. So I use all this. I look for specific companies, ones that are, I think, highly leveraged to the moves that are inflecting from losing money to making money, or they're coming out of big basing patterns and they're already making money, and we get to buy into that strength. But let's look into it. Let's see what we've got here. So I'll first start, I'm going to go all the way up real quick. I'm going to start with the CRB index to S&P 500. This is the big boy chart. So just really quick, stocks outperformed during this period when, and money went into stocks and not into commodities when this ratio was declining. Right here at this inflection point of this circle here, that was the inflection point where a new paradigm occurred, and we went into an inflationary environment. That was the bottom of 2020. And now commodities are outperforming. This is wave 1. This is wave 2, some sort of bottom whenever it bottoms. and then we'll go into a big, gigantic wave 3, which is the largest wave that is still ahead of us. So that's what's coming, and the ratio is still very cheap for commodities. Commodities are cheap in this particular instance. Red line to red line is when you want to invest in stocks. Red line forward is where you want to be in commodities. So if we were to look at specific sectors and commodities of ratios. So I'm going to pull up the precious metals, and I love me some precious metals. Don't get me wrong, guys. The reason I like precious metals so much is because your risks are very low and your rewards can be very good. So you're side skirting all of the risks well, not all of the risks. You're side skirting a lot of risks in the world that are tied to basically everything that a regular stock investment may have. That could be poor management, poor country, nationalization, increased taxes, increased fuel costs, increased inflation. They can't find labor, et cetera, et cetera, et cetera, et cetera. There's like a million different things that can impact a stock. This is a lump of metal that you can trade back and forth and gain in value over time. I think it's one of the least risk ways to make money, and you're also holding your wealth outside of the system. But right now, platinum's very cheap to gold, and we've broken out to the upside of this pattern. It's a little downtrend falling wedge, and I do think this will eventually work its way higher. It goes higher in commodity market booms. This is your Batman pattern. That's called the Batman. That's a topping pattern, and then it generally moves down for a little while, and we are putting in a bottoming pattern. So platinum is favorable to gold, and I'm going to go a little bit quicker through these. Platinum's favorable to palladium. We can see that it's bottomed and it's starting to move on up. So I think platinum is the one. It's at 0.67. Platinum to silver is also in a falling wedge. You've got 1, 2, and then 3 over here, the humps, and we're starting to break to the upside of that last hump. And there we are, breakout, retest, and I think we will eventually work our way higher in the beginning of the bull market where platinum outperforms silver. So platinum is cheap to all three precious metals. It's set up very well. Gold to silver ratio, I think silver is going to outperform gold. We are at a very cheap level for silver. And what you can see is a breakdown, retest, and I think we're going to eventually work our way lower where silver outperforms gold. So what we're going to see, and these can shift over time, guys. I think platinum will do very well in the beginning of the bull market, and silver could do well, and they could both run together. I don't know the future. I don't know exactly how it's going to play out, but if I were to take a guess, platinum will outperform everything. At least that's what I'm hoping for. And then I hope I can swap into silver, and silver just absolutely destroys it. That's what I hope. But hopes don't get you anywhere. It matters what really happens. Here's palladium to silver. This is coming down, which means silver is outperforming palladium. And I do think we might get a return move, which looks something like this. And then we'll come back and roll back over where silver will outperform palladium. Palladium does very well in disinflationary environments. Silver does very well in inflationary environments. So I think we're going to see another move lower in where silver outperforms palladium. Dow Jones Industrial Average to gold. I do think gold's going to outperform it on a long-term basis. Down, and then I think it's going to go down. And we'll see another move lower where gold outperforms the Dow Jones Industrial Average at some point here in the future. And then we've got gold to oil ratio. The gold to oil ratio is cheap, actually, for oil. I know it's kind of at 24 or so. 24 is still very cheap for oil. The really cheap area is about 30 and higher. So this is kind of that area where I would say, I can't draw it that straight. Let's do this. This is about 30 and higher. That's super cheap. And this here is an anomaly, guys. This is like a buying opportunity of a lifetime in oil. And I took advantage of it. But I do think this will continue to work its way lower over time, where oil outperforms gold. And then we've got copper to gold ratio. Copper's been pretty strong, but we do have this big selling pressure move, and we've been struggling to work our way up against gold. So I'm wondering if this is going to turn back lower, where gold could get a really big move at some point here in the future. But again, ratios don't tell us how, assets are going to perform in the future. It just says if something's cheap or expensive. Last bull market, copper did very well. I do think eventually copper is going to work its way up against gold, as copper is used across many things that we are trying to transition to. We're going to go into some of the ETFs here. So we're going to kind of fire through these. So URNM versus XLE. We're right on that resistance line, and we're struggling to break out right now. But when we break out, I think URNM could outperform XLE, and we get a gigantic move to the upside here. So URNM is one to watch versus XLE. URNM versus natural gas. We've had a massive outperformance of URNM, but that was mainly from natural gas falling. Natural gas right now is very cheap against basically all assets. I think natural gas is an incredible area to be looking at. URNM to XOP, we are kind of breaking this to the upside here of this downtrend line. And I do think eventually uranium will outperform everything. It just needs to wake up and break out of its big patterns. It's still consolidating. We are getting closer. URNM versus platinum. This here does look like we could potentially work our way higher for URNM outperformance against platinum. It is an unfair comparison. URNM is the miners, which is much more leveraged. Platinum is not a leveraged product. URNM versus NDQ, it's still squeezing up. It's looking good for URNM. URNM versus the Commodities CRB index. This is 1, 2, 3, 4, 5, 6, and then here is your Livermore accumulation cylinder that usually breaks to the upside. So URNM is still very well positioned for a gigantic move to the upside, even against Commodities itself. URNM versus OIH. Now, this one's interesting. OIH could outperform here for a period of time, but I also think it depends on when URNM really starts to take off. So if we kind of zoom in with the daily candlesticks, you can see there's outperformance of OIH. That's why it's going lower. So OIH, which is the energy service companies, is actually looking very good. And it is very cheap against a lot of different assets. So OIH is kind of interesting. URNM still squeezing up against REMX. Will we see this break and move to the upside? That means URNM could have a very big outperformance ahead of us. So that could be good for uranium. Uranium, URNM versus COPX. Looking at this, we're still kind of chopping sideways. But more or less, if you look at it, it is one big kind of gigantic cylinder. And we're kind of midway for the valuation of URNM to COPX. So it's interesting to see where this thing will break. And I don't have a clear direction on this guy. I mean, you could draw this more like that and hit the bottoms of these guys, kind of skip out on those. But we'll see which way it breaks. And then URNM versus the S&P 500, we are squeezing up into this pattern. I think URNM is going to break to the upside at some point. Maybe we have a little bit further to go in time to kind of consolidate sideways for URNM. Now switching to XOP versus REMX. What this is signaling is that we are actually, let me back out here, that we could potentially break to the upside where we see XOP outperform REMX. This one up here, you can see all these big candlesticks, these big red candlesticks like this, and it's struggling to come on up. What that is signaling is that we're going to have a move lower where REMX is going to outperform XOP. And then what happened is we bottomed, and this is where you want to get long in XOP back in 2021, at least against REMX. And I do think we could see further upside for XOP. XOP versus MU, definitely looking to go up to the upside here for XOP. So XOP looks good against the agribusiness ETF. We've got XOP versus OIH. This is the energy service companies. Energy service companies still look good. There could be a move higher here before it comes back lower, which is a retest move. So generally what you get is you break out of these patterns here. It looks more like that. You break out of this trend line pattern, you come on up, you do a retest, and then you break lower. So that's what we've got for XOP versus OIH, and I think OIH will outperform. Looking at XOP versus GDX. So GDX is our gold and silver mining companies. What I would like to invest in is XOP. You get in down here and you ride it on up, and then you sell it, and then you ride GDX all the way back down. But we are still very cheap. It still looks like we could potentially move higher. It looks like we've broken out of that resistance line and doing a back test. So I think XOP still looks good, and we're about evenly valued right now against each other. XOP versus crude oil, I would say this is definitely in favor of XOP continuing higher and beating crude oil. So that's looking good. We're just in a consolidation kind of pattern here, moving sideways. XOP versus COPX, we are still very cheap for XOP, the energy companies, to move higher. So that's what I would put my bets on. Now, looking at OIH energy service companies are ridiculously cheap against most everything. MU has had a massive outperformance over time, but now XOP or OIH is starting to come, and I think energy service companies are going to come into light here. So OIH looks good. OIH looks good against REMX. I think that's going to go higher. And remember, OIH was good against XOP, so energy service companies are the spot to be, in my opinion, and we are breaking out to the upside here. I think we could see a big move in energy service companies. GDX, so we're looking at more of the GDX against some of the ones that we haven't compared to yet. So GDX versus gold, we are still very cheap for GDX against gold, and we're trying to put in this big basing pattern right now. We have not broken out of that basing pattern. GDX versus REMX, this looks fantastic. This is a liver accumulation cylinder. 4, 5, and then 6, and then 7. This is generally where you want to buy, and you ride it on up. So GDX looks very good in relationship to REMX, and I would definitely be choosing GDX over that. And then GDX versus SILJ, this is more or less the same chart, if you can remember, as your gold to silver chart. It's the same chart. You have a breakout, retest, and I do think we'll come back down. SILJ is cheap in relationship to GDX, and I do think they'll see an outperformance of SILJ soon, is what I'll say. And then looking at copper, copper against OIH, I would say OIH is going to continue to outperform COPX. So energy service companies have the upper hand there. And then COPX versus GDX. GDX is very cheap up here in relationship to copper. We could see this come back down at some point where gold outperforms copper, and then GDX, the ETF, will outperform COPX, the ETF for copper. So if I were to kind of look at this and draw some conclusions of what we just saw here, I think the cheapest is probably energy service companies. They look very good. I think SILJ looks pretty good, just kind of looking at it. SILJ, I think, might need a little bit more time to consolidate because I just don't see the turning in the buying pressure yet. Doesn't mean it can't turn very quick. I just haven't seen it yet. I think URNM's looking quite strong from just kind of a general overview against all the other assets. I think when that wakes up, it's going to be like game over move for uranium when that wakes up. We're still consolidating. It's consolidating, which is fine if you're an investor because you can accumulate much larger positions in a consolidation that lasts a year or two. So I don't look at these things as negative. I look at them as positive as I can continue to accumulate my favorite companies at a good price. So either way, you win depending on the mindset that you adopt. But right now, of all the different sectors, I would say energy service still, I think, is probably the best looking and the most ripe to make a move in the short term. So that's cheap. It's moving positively against most of the assets, and it's breaking out of resistance levels. And there's been a lot of good investments this past year in energy service companies. I've gone over a lot of them, in particular on the website for the Platinum members. We've done very well this past year. Now, I don't make a model portfolio because the portfolio highly depends on how you weight these companies. Some people, they may weight something that doesn't perform as well as another person who weights something that's gone up 400, 500, 600% in a year. And their returns are going to be vastly different between those two. And I leave it up to each individual. I don't say anything. I'm just saying, this is what I'm doing. This is where I'm going. This is where I'm going big. and I make sure everybody knows that's a platinum member what I'm doing. But yeah, we've done very well in the energy service sector. I'm still going to continue to ride this thing higher. I also think that there are select opportunities in the exploration production companies. There are very good opportunities there. Some of these small caps have not left the station. They're still low, and they're putting in Livermore accumulation cylinders, which means wave 1's complete. We're down at the bottom of wave 2. That's where we want to be looking. Another thing, uranium companies look fantastic. The only problem I have with uranium companies is they're not cash flow generation machines. They're not cash cows is what I call them. They are more speculative. On the other hand, though, when they get moving, they move fast. They move big. And hopefully we get a very big wave 3 out of this move where these uranium companies just kill it. Because I've got a good enough stake in there where it's going to make a difference. I'll just say that. But that's what I've got for today, guys. Hopefully you enjoyed it. Hopefully you gathered something from this. And if you guys are interested, definitely join the community. You can use the word discount if you sign up. And that's all I've got for today. So we'll catch you next time. This is Finding Value.